At the opening of Business Today's 7th Taiwan Future International Summit on Wednesday, President Lai Ching-te vowed to transform Taiwan into a hub for AI innovation despite ongoing geopolitical tensions.
We will expand cloud infrastructure, build cloud-based data centers and supercomputers in Taiwan, develop our own generative AI core technology, and guide small and medium-sized enterprises in the use of AI tools so that AI applications can continue to proliferate.
In
the face of climate change challenges, Taiwan must firmly implement the 2050 net zero emissions goals. The government will continue to expand the development of wind and optoelectronic power and accelerate the development of diversified green energy. We will also build smart power grids and strengthen the construction of power grid resilience.
Meanwhile, Martin Wolf, the chief economics commentator for Financial Times, discussed the emerging economic order of the world.
The pandemic caused, interestingly, extraordinarily strong demand growth. That was not what people expected when it happened, but the monetary and fiscal support given to major economies was so large that we ended up with extremely strong post-crisis demand growth. That long-term interest rates, which I will be discussing, will probably not return to where they were before 2021. We are moving out of the monetary environment that existed from 2008 to 2020 after the global financial crisis. A reasonable guess, my guess anyway, is that with real interest rates positive again at around 2%, this shows the real interest rates in two countries that have been issuing inflation-indexed long-term government bonds for quite a while, namely the UK and the US. You can see real interest rates, red for the UK, and more importantly, purple, the purple line is the US, have exploded upwards to 2% in the US case, rather lower for special reasons in the UK. So real interest rates have gone up. Let's assume they're going to be 2% in dollars. We have an end to quantitative easing, which is monetary tightening, of course, inflation expectations at around 2%, and a slightly elevated inflation risk premium. Nominal yields on 10-year dollar bonds should settle at somewhere around 4 to 5%. So the current level looks sustainable. Of course, another huge negative shock to demand could reduce real interest rates to negative levels once again. This is rather an interesting chart produced very recently by economists working at the World Trade Organization in Geneva. Essentially, they've created a sort of hypothetical, but not imaginary, trading blocks of countries that are relatively close to China and Russia on the one hand, and blocks that are relatively close to the Western powers, the US on the other. And they're trying to look at what's happened to each, to trade within and between these blocks. And this is nominal dollars indexed to 100 in early 2022. And the key point is very, very clear, is that trade between the blocks, across the blocks, has shrunk significantly, about 10% in the last 2 years, while within the blocks it has not. And this is, I think, the first, or among the first really good indications that we are seeing a decoupling. My conclusion has not collapsed, but it is threatened by decoupling and outright protectionism. As a general rule, tariffs are bad policies because they're very poorly targeted. In particular, they create home market bias, and this just doesn't work very well when the market is not very large. But what makes them attractive is the politics. They are targeted politically at foreigners and ignore domestic sources of economic and social problems. And so we are going to be stuck with these trade wars, but they're not going to do anything